hello. So thank you guys all for joining today. I'll maybe start with just doing introductions and having you guys introduce yourself. So maybe we'll start down at the end.
All right. Hi, everyone. My name is Joanna. I'm an investor at Emerson Collective. We are a social impact organization founded by Laurene Powell Jobs, really focused on tackling some of society's most pressing challenges. And we do that in a few different ways. We employ tools ranging from policy to philanthropy to venture capital. I'm on the venture team, and how we think of deploying capital is really about investing in what we call consequential companies, so those that sit at the intersection of both generational returns and venture scale returns. And so we absolutely do not view it as a trade-off. And climate tech is, of course, one of the areas that we spend a lot of time in, both on the deep tech side and on the verticalized software side. So just excited to be here with you all.
Awesome, and thank you. I didn't say it, but if you could also just talk about where in the capital stack you sit, given the topic of our panel. I think you covered that well.
Of course. So our fund overall is entirely multi-stage. We'll go as early as pre-seed, as late as IPO. I myself am focused on the early stages, so pre-seed through A, but our fund is entirely multi-stage.
Great. Hi, everybody. Brock Mansfield. I'm the managing partner of Meliorate Partners. We are a family of funds that invests in founder to pre-seed innovation around climate and sustainability. We think of the world actually, I guess, slightly different in that when we think about investing, our whole mission is driven by this idea that for the last 200 years, we've been building an economy based on a set of assumptions that are no longer true. And this whole sense of, at the time those decisions were made, they made with the best information that they had possible, that resources were endless, that we could move forward as an economy without consequence. And so our whole fund and our whole family of funds is built around this idea that we have new information now, and we need to build an entirely new economy that reflects the fact that there isn't endless resources, and there aren't consequences to the decisions that we make. So we have about 53 portfolio companies. We've been doing this. We're on Fund 3 right now.
No biggie. Whole new economy.
Scarce
resources.
That's what we're after.
Diane.
So hi, I'm Diane Schrader. I'm the founder of thirdACT. We're a public benefit corporation. You can think of us also as a fund manager, very much focused on project finance, particularly in funding resilience and decarbonization in the built environment. But there's another hat that I wear, and that is that the company began hosting an event back about 6 years ago called the Climate Salon. So we've been convening institutional investors with the mission of accelerating their investments in climate. And that's something that I really want to focus on today, because I think that, especially in the presentation that you just gave, so importantly, we think about technology as being a key driver to solving these problems in climate, but also finance is a really, really big deal. Where we see a gap based on the institutional investors that we work with is that early stage emerging manager. So as you were an emerging manager at a certain point, everyone I think on the stage at a certain point has interacted with these parties. You need to build these emerging managers to the capacity that institutional investors will invest. And so back in 2019, we were asked to develop a fund of funds to invest in these parties. We've been chewing on that idea for several years now, and we're now building this out. So if you think about a lot of the capital that's gone into climate managers, there's just been a lot of the oxygen kind of sucked out of the room as it's gone to these multi-billion-dollar opportunities.
Oh, we could have a long conversation.
Oh man, so we need that, right? We need that, but we also need to grow these amazing emerging managers, which is tremendously important to us. And then the last thing that I do is, for the last 9 years, I've been involved in various classes here at Stanford. But for the last 3 years, involved in Hacking for Climate and Sustainability, and as of this last quarter, really interestingly, in Hacking for Defense as well. So very, very committed to the school and to the various founders and parties here too.
I love it. I think we'll focus here on funding, kind of innovative companies. But I do think that the topic you raised around where the funding comes from for the funders of the companies that are kind of doing the innovative work in climate is a whole kind of, obviously we can only fund as much as we have to spend, and our capital comes from limited partners who thus, need to believe that there's an opportunity here, need to appreciate that there is commercial return available kind of investing in this category. And that's, I think a lot about this being a human capital kind of education challenge we have, that we need to kind of not turn over that capital stack, but maybe kind of spread the word to that, as well as obviously our physical capital stack. Terrific. Well, maybe we'll start, and I'll throw this open, but certainly you guys who work in early stage, all of you with early stage companies, put that slide up about kind of recently declining graduation rates, and I think particularly doing work in a sector where we feel like there is so much need for more capital. Yes, we need another food delivery company and another mattress company, but we really need climate companies, and we need them now. So seeing those, graduation rate statistics go down is particularly painful, I think, in this category. So we'd love just to hear a little bit more about kind of the funding environment you're seeing today for your companies, as you look at companies. As investors, I think the biggest thing we do is allocate our time. And so if you could talk a bit about how you think about allocating your time, what makes you dig in on something. I'm sure there are folks curious.
Sure, happy to share more here. So I think, even as you shared on some of your slides, the environment for early stage startups is actually quite robust. I think we are seeing a huge number of entrepreneurs really jump into climate, more and more talent flowing in part led by institutions like Stanford. And I think it's really an incredible time to be building at the earliest phases. There's a lot of dry powder out there, right? So a lot of capital that's been raised for early stage funds that has yet to be deployed. And so if you are a really ambitious founder at the earliest stages, I think it is a great time to be building right now. That said, is fundraising always easy? Absolutely not. You still need to be incredibly practical in terms of how you will ultimately get to revenue. You still need to have a really practical plan for how you will commercialize your technology. And so we always encourage our founders to really start building relationships with buyers from day one. We don't expect you to have a purchase order if you're a pre-seed startup, of course not, but really keeping those relationships warm, understanding what they're looking for, so that when you're actually ready to start selling 2, 3, 4 years down the road, you're not starting from square zero. You really have a lot of these warm relationships, which position you to get things like off-take agreements down the line, or position you to structure licensing or JV agreements down the line. And so really having that kind of commercial mindedness, I think, is so huge. A great example is we have a founder in our portfolio, actually came out of the Hacking for Defense course. And when he set out to raise his first round of funding, it was actually incredibly challenging. His deck was 30 pages long, all about how amazing the technology was, but really didn't share about why is this important and who will pay. And his hypothesis about who his buyers would be were consumer electronics companies, which, if any of you have ever sold to them, they're really hard customers. They change their minds, their roadmaps change, and then you're out. One day you're in, one day you're out. It's really all about trends, right? And he got a lot of feedback from investors. He's a super fast learner, slimmed down the technology piece, put it in an appendix for anybody that wanted to dig in, and then really thought about all the other markets where his technology could be applicable. And he had already done a lot of customer research with these folks, but just wasn't bringing that forward in his deck. And so by helping him to restructure his value prop, by bringing some of those conversations forward, he ultimately raised an incredible round led by Union Square Ventures, one of the best funds out there. And then he really took that to heart, all of that feedback, because it took him 6 months, by the way, to raise that round for his Series A. So by the time that he went out for the next round, and Series A is actually generally much harder to raise than your seed, he had spent so much time developing relationships with commercial partners, with de-risking his technology, with showing that he had, LOIs from people that were ready to buy should he hit certain milestones, that it actually only took him 2 weeks to raise his Series A, because he kept these warm relationships with commercial partners, with investors, and really was able to storytell effectively. So I think overall, what we're excited to dig in on are entrepreneurs who are extremely ambitious, solving really tough challenges, but are commercially minded, and there's a real path to scale.
Amazing.
I'm just going to let Joanna say everything because that's perfect.
Yeah, I feel
You
like
just keep
that,
going. I'm just going to stand here and listen to you. That was wonderful because I think as a founder to pre-seed investor, we actually find a very similar situation. We are not seeing any issues, or at least as many issues with early stage funding, and whether that's from grant sources or whether that's from venture capital, that we feel like there's a fairly wide funnel right now as far as sources for early stage capital. We are not seeing early stage companies not get funded, the ones that should. I mean, not everybody's going to get funded, but the ones that really have a compelling idea, a great team, are thinking about this. Where we see the challenges is downstream in the Series A, Series B, and I'd say 90% of the time it's because of exactly what Joanna touched on, which is this whole issue of the difference between pilot revenue and offtake revenue. Like, that's one thing I'd stress for any entrepreneurs here, right? It makes a huge difference, and you need to be thinking about this from the very, very beginning of your effort. Who's going to be your customer? Why are they going to buy? How are you going to get from that pilot to the offtake agreement? We see a lot of companies that are like, hey, look, I've got these great brands, I got great billboards, we've got pilot revenue, even like $1 million, $1.5 million, but we're finding that the downstream investors are really looking for true scalable offtake agreements. Because, and maybe the last thing I'll say and then pass it on is, our experience has been every venture investor is thinking at least 2 rounds, if not further down the road. So people are like, look, I hit the A round mark. Well, that's not what you should be thinking about as a founder. You should be like, what are the B round and the C round and the D round people going to be thinking about? What is the trajectory and what's the velocity I need to maintain in order to get a 2-week A round done? And I think that's a great example that if you've really set that up right, it actually can almost get easier as you go along. Not always, but a lot of times. So really thinking about what's the horizon look like, where do you need to be, where's the puck going to be, kind of stuff. Super important.
Amazing.
Yeah, just to add to that very quickly, what I think also is really important for startups to understand is that the reason why seed investors are investing is not only because they believe in you, because they also believe that their investment is going to make a difference. So articulating what that is such that those investors can then go back to their LPs to demonstrate, guess what, our startups are growing is tremendously important too, so where that can be done. So kind of going back to the fund managers and such, it's really interesting. I heard a fund manager on Sand Hill Road say, we're backed by nonprofits. And this VC is very well known, one of the big brand names, and it was kind of a funny thing to hear. But then if you look back at who they're backed by, again, they're primarily backed by pensions. So about 73% of venture capital comes from pensions, and pensions are by default nonprofits. And it's really interesting to think about that. So I typically meet with 1 to 3 venture funds a week focused on climate because they want access to those parties, because these are the parties that attend the climate salon. And what is just killing me right now is seeing the number of phenomenal VCs that just aren't raising as much capital as they need to within the climate space. And so what I would also then challenge you as both funders, as startups and such, is to also think about their business models as well, and what helps them grow and attract more talent. Attract better startups. I mean, ask them the practical questions about where they are in their fund size. It's also really fun to say, guess what we're raising? When is the last time you raised? What are the questions that that investors are asking you now that they weren't asking you, just even a year ago? Especially because times have changed so much. So yeah, understanding the business model behind the VC is tremendously important too.
Absolutely. That was incredible. And I feel like that, kind of Joanna, Brock, what you guys were saying about kind of thinking about your commercial value proposition, even when you're in a stage where you're just working on the technology. Because I think there's lots of interesting technological problems that we need to solve, but ultimately they can only have impact if they scale out in the world. So as you are developing whatever solution set you have, thinking about who is the ultimate buyer, what are you competing with to get them to listen, to get them to actually entertain your value proposition? We have so much technology, it feels like, that is superior. Unfortunately, we're not starting with a blank sheet of paper. We're starting with an incumbent economy and all the frictions that come with it to displace either an asset that's actually already there or just displace the thinking that causes people to default to what they've done before. And so the question is, what is your wedge? How are you actually going to wedge your way in to whatever market, and thinking about that from the very beginning, and how you're gonna start laying the groundwork to be able to wedge your way in when your technology is developed. It's a lot to all think about at the same time, for sure. Maybe then, just to kind of carry that forward, having to think many, many steps ahead, as climate companies often do, talking about that folk gap. I'm curious, kind of, if you all have here experience with companies trying to tackle that folk project finance, or even the second of a kind, just that early capital intensive, taking an innovation and deploying it into a physical real asset. And just any advice you have for companies who either are dealing with it now or may have it in their future, and how they should be thinking about it.
Brock, you want to take this one first?
Sure. I think we have probably 4 or 5 that I'd say fit that category in our portfolio. And I think that the biggest challenge for sure is those really early dollars. I mean, how do you, when you don't have even a market, you're like, I mean, this whole idea of like, hey, go find out who your downstream customer sounds great until you're like, well, I'm doing something brand new and I don't even know who the customers might be for this. And to be honest, I think I'm just going through my head here. I think every one of those has ultimately gone a grant funding route for that early stage. And I know there's a lot of talk about the IRA these days. Actually, all of them, I think, have gone alternative routes, most of them through like a DOE or USDA. If you're not familiar with those in this audience, I assume most people are, but if you're not, I'd say 2 things that I'd speak to. One is really understand, first of all, just the resource landscape, because the resource landscape is phenomenal if you know where to look. The second one is, and as far as raising money, it doesn't take a lot of money to do this, but find a really experienced grant writer. I think so many founders are like, hey, we're gonna do this, we're gonna shuck and we're gonna jive and we'll do it ourselves and DIY the heck out of this thing. It's like, huge mistake. I mean, just don't. Find a grant writer, find someone that can help you navigate these, because they're gonna know where, in some cases you can get both where to go and as well. But I wanna say, on average, I'm just thinking about the grants these companies have gotten, somewhere between $5 and $15 million just to start, just to basically figure out if their technology is even possible and if it works. And it was really great for them to be able to do that before then they got into the whole venture stack.
Yeah, that's super interesting, because that is really a stage where it's super, the risk is incredibly high, and venture dollars don't love.
Yeah.
They often don't
I would
scale
follow. Yeah,
into
that's a
that.
great point, because like I think some people are like, oh, I'll go find venture. They're in the risk business. And little secret for a lot of you if you don't know this secret. Yes, we are in the risk business, but not that part of the risk business. I thought that was a great slide you had up earlier too, because that really does define it. Like there's that whole box in the bottom left corner. We're like, yeah, we don't want to touch that. We're gonna let that be.
And folk is starting to hit that too.
Right.
It's really just as you get into bigger dollars. Again, our capital stack was built for digital innovation. You don't need that much money to digitally innovate all of a sudden after you've already progressed it, right? So it's sort of a misfit.
Yeah, I think, building off what Brock said, so I think I totally agree. I think, where we've seen founders be the most successful, especially on the deep tech side, is they first pursue grants, and they can come from a variety of different sources, DOE, DOD, DARPA, whatever the right agency or agencies are for you. And really, after you've spent maybe just a period de-risking your technology from a scientific perspective, or even while you're doing it, again, trying to be as commercially minded as possible and building relationships. So one of our companies, this is all public information, is a company called 12, and what they do is they convert CO2 into CO and then use that to make all sorts of clean chemicals. And initially, they weren't exactly sure which market they were going to go after. They pursued grant funding, got it from different agencies like NASA and others, and just really started going out into the market and talking to people. And the key for them was really unlocking their first marquee customers, which was Mercedes-Benz. Obviously, that's a huge name, but it's one customer, it's not 20. But that really enabled them to have enough traction in the market to go and raise venture dollars. And venture capitalists were really excited by the potential. They were 3 really incredibly bright students out of Stanford. And then after that, they actually realized that yes, this initial kind of pull from Mercedes was interesting, but really where the bigger prize was in sustainable aviation fuel or SAF. And it turns out that those customers, the airlines, can pay really big dollars. And most of them at this point have all made like pretty significant commitments to decarbonize their operations. And so they were able to actually build relationships with these folks and secure offtake agreements. And so that even before they had any sort of project finance, they had these like multi-million, in some cases billion-dollar kind of offtake agreements lined up, so that when they actually went out to go and build their first-of-a-kind plant, it gave enough comfort to the folks on the project finance side of the house to actually fund them. And so they actually, there was a ribbon-cutting ceremony about 6 months ago. It was a huge, obviously, win for them. And so that's kind of like the best case scenario of how can you really just be commercially minded from day one, pursue different kinds of funding for the stage that makes sense for you, and then ultimately kind of secure that project finance.
And I will say in my experience, I've certainly seen a number of startups that have run into issues with scaling because they didn't anticipate that interest rates were going to go up so high or so quickly. So that while they were funded as a company several years ago, financing their scale-ups and such is more challenging now. And so one of the things that I'm definitely pointing these parties to are donor-advised funds. Donor-advised funds, this is capital that was given. Typically, this is invested before it's granted, and there are all sorts of ways that one can tap into that to finance either at or below market rate with a variety of different mechanisms and such. I had a meeting with a VC that I remember kind of pointing to in 2022, I believe. And don't get me, actually, I have some of the numbers written down, so maybe I can get it. In 2023, all of venture in the United States raised $67 billion. In the DAF space, it was 72, and it had grown 28%. So venture, unfortunately, has gone down. DAF has gone up. And so even just adding this to your deck is a helpful slide to say, hey, by the way, even if you're presenting to venture capitalists, VCs often have their own donor-advised funds. And then on top of that, of course, there are a variety of more commercial funds as well. But I think it's an important strategy for parties to keep in mind.
Yeah, it's interesting. I always think about project finance in my very simple mind as you have an input, you have an output, and then you have a box in between that like transforms the input into the output. And so as you guys were describing kind of the how de-risked is every one of those three elements? Do you have access to feedstock at a fixed cost? Do you have offtake or line of sight to it and at a fixed price, both price and quantity? And then you have the tech in between, and lots of time there's a lot of focus on the tech in between that's transforming your input to the output, and how confident are you at the cost of that conversion? And so whenever we actually have made a few investments that involve kind of our dollars going into early iterations of the deployment of a technology into a real assets. But that's sort of the push, is like how certain do you feel about the input, the output, and how good the tech is. But yeah, it's a challenging.
I would just follow on with that. I think that's a great point, because we talked earlier about the importance of offtake agreements. But if you're building a company that's going to require project finance down the line,
Yeah.
I think controlling the inputs and making sure that, about 20% of our portfolio is in waste to value.
Yeah.
And a lot, it's wonderful, right? We're trying to figure out how do we create these closed loop systems and true circular economy plays. But the reality is that the vast majority of them are really struggling to figure out how do you actually lock up your supply.
Yeah.
And so often what we see, it's like that you get those initial pilots going and everything's kind of plugging along, and all of a sudden whoever's supplying you your feedstock goes, oh, this is valuable? I thought it was waste, right? Well, now you've got a margin compression problem. And so really thinking those things through, and then because at the end, you're exactly right, and we've got a bunch of companies that have gone through the project finance, built out factories for this, et cetera, and every time it's like, okay, those are gonna be your two big questions, input and output.
Yep.
Do you have them locked up? Do you really have real offtake agreements? And do you have a way to control the inputs that you have? So again, very early on, as you're thinking about your business model, making sure you're thinking those things through is going to be really important for any founders.
The inputs can really get you.
Really get you.
You think it's waste. Who wants
Yeah,
it?
here, have it. Take it away from me. Oh, wait, it's valuable. Hold on.
Give it to me, and then all of a sudden they realize that there's value to it, and then they want a piece of it.
Absolutely.
But I'll also add that almost 3/4 of startups within the climate space involve hardware. And I would argue that there are quite a few VCs that are kind of coming into hardware that just don't have that level of experience. So definitely startups need to talk to they really need to understand the business. There are a lot of parties that brought their brand into climate but don't necessarily have that level of experience. So when it comes to hardware and manufacturing, you don't always have control over those supply chains. And we've seen a number of startups just get completely bogged down by the fact that the parts just are not available, or the volatility in price and priority and such is just scrambled. So that's also something to keep in mind at the very beginning. And how you might de-risk is certainly convincing investors that you certainly have a handle on that.
Yeah, for sure. As we're talking about kind of offtake, but also input costs, just to continue on this thread, I think we sitting here often kind of get in our innovation bubble sometimes, which is a little bit separated, I think, from the incumbent industrial economy sometimes. But I have feelings about that feeling. But I guess I want to put that question to you, which is like, what is the role of the incumbent economy, of strategics, of these large industrial players? What roles have you seen them play with your companies? How do you advise your companies to engage with them? We've talked about engaging with them as customers potentially. Early on, we've actually had them come in as co-investors. But I'm just curious, kind of any guidance or advice or case studies you have on how, kind of for a young, innovative company, how they can engage with incumbents and how they should be engaging with incumbents early in their life. Let's start down here.
Sure. So this is really interesting. I think there are two reasons why corporates or strategics often invest in startups. And I think it's really important for startups to know the difference. The first is sometimes they're just there to learn. They just want to stay abreast of what the technologies are and where the trends are and such. They might not have the long-term interest or might not be as strategic as one thinks. So I might reflect on them more as tourists than investors, but nonetheless, they do have a tremendous amount of capital. And then where one does bring in strategics, where there is long-term alignment, I think it's really important to think about how those partnerships evolve, particularly, is it something that you might want to bring a group of strategics in as opposed to just a single? Because just like too many eggs in one basket, I think one has to be very thoughtful just about not aligning too much with a partner that might not be the best long-term. Sorry if that's not the happiest side of strategics, but.
No, I agree. We often get this question, especially at the early stage. The strategic is really excited in investing in our seed round. Like, should we have them be a part of it? Like, it's amazing. They're such a big name. And oftentimes our advice is no, it's too early, because it does present this conflict risk, right? Like, if you are working with Mercedes and yet you're trying to sell to, I don't know, Honda, like, you could see that might be a conflict down the line, right? And so you don't want to, just to your point, put your eggs in one basket. Now, like, down the line, it could make sense, right? Like, you're more scaled, you have revenue, maybe you're working with a few of these partners, so working with a couple of the different strategics could make sense. And oftentimes, they do play a really critical role in filling that capital stack gap. Like, we have seen these players come in, especially like the Amazons of the world in particular have been really active in some of our spaces in providing like really transformative capital to some of our companies. So we do think that they play an important role. And oftentimes, like, these are also players that are willing to pay a green premium, frankly, until you're kind of coming down that cost curve because they have enough cash on their balance sheets. So they do play an important role, and we just advise our companies to work with these players in a very strategic way.
Agree with everything that's been said. I will try and throw maybe a third perspective, which is our experience. And I'm actually going to do a shout out for Stanford Climate Ventures here, because I think one of the great things that they teach there to all the students that come through is they have this phrase of like, if you're going to take dollars in, if you're going to take a pilot customer, who really wants to be in the foxhole with you? Mm-hmm. And this is such an important thing, because whether it be capital, whether it be pilots, whether it be anything else, there is a huge difference between getting capital and getting a pilot, and who really, really is going to help you move at the speed that you need to move at. And we've started to teach within our portfolio things like contingent offtake agreements. is something that we're talking a lot about right now, right? It's one thing to get an offtake agreement, like sure, when we get through these pilots, we'll do something. We've seen those pilots last, 2, 3, 4 years, which is a death knell for startups. So we're telling now our portfolio companies, like when you go to, and you're talking to all these different folks, like ask them, are you willing to do a contingent offtake agreement? That if we hit these numbers on the pilots within 18 months, will you do this and move us to contingent pilots? So the only flavor maybe I'd add to the great comments that have been made so far is really be thoughtful about your pilot customer or your pilot partner, whether it be capital or whether it be for a future customer, and really try and get to the heart and use questions to discover whether they're going to help you move at the speed that you need to move at if you're truly venture-backed.
Yeah, that's great advice. That speed point is one of the biggest challenges, is just their urgency around transition is quite different from yours if you're a young company and you're kind of either single or even dual-threaded on a couple big customers. So that's a super...
Back to the risk business, right? I mean, they're
completely.
not necessarily in the risk business. They
That's right.
they've got big enterprises to protect.
Yeah, for sure. Should... I have a few more questions, but should we open it up to questions now? I know we were... Okay. Well, maybe just the last one then. You guys referred earlier on to grants and companies being successful in securing grants. We've got, USDA, DOE, because it crosses every sector of our economy. There's lots of different places and lots of different levels of government, I would say, to get, to find support. So I'm curious just how you all think about, for an early company, how they should be thinking about the policy framework in which they operate. And I know that's a very, very broad question. And candidly, it's much bigger than the IRA, for sure. And so maybe I'll just start if anybody has any thoughts there. Maybe Joanna, we can start with you.
So as I mentioned earlier, so we do have a policy team that really thinks about these issues deeply. And I would say at the earliest, so first of all, it's never too early to be thinking about policy and how it impacts your business. In the earliest phases for climate tech startups, oftentimes it comes in the form of grant funding. But as you kind of move up the capital stack and continue to raise more dollars, like there could actually be a time where you decide to actually think about, well, how do I engage with legislators? And how do I think about even influencing policy? So I think at the earliest stages, it does help you stay alive, but then you can kind of like mature and start to think more outside of the box. I think a good example of this is a company like Commonwealth Fusion Systems, working on making nuclear fusion a reality, no small feat. And Bob, the CEO, is probably one of the most active people right now in the climate world on Capitol Hill, really trying to advance nuclear policy with actually the Advance Act that was just passed in the House earlier this week. And so he's really trying to change like the entire conversation and debunk a lot of the myths around fusion versus fission and kind of all of the rhetoric that's been out there to date. And so our policy team has actually been working really closely and with him in terms of like what messaging do you use? How does that change if you're speaking to a Democratic audience or a Republican audience? Republicans generally, or conservative audiences, climate, sustainability, decarbonization, these are like allergic words, right? Like you want to talk about jobs, the economy, resilience. Like nobody wants their children to grow up with bad water. Like everybody is on board with clean water. Nobody wants their children to grow up with asthma. And so like figuring out like how do you tailor your messaging is something that we really work with our companies really deeply on. And again, that really changes kind of where you are depending on your company life cycle, but it is critical to be thinking about it from an early stage.
I'll jump in and say that when we think about regulatory issues, we always think of them in terms of two buckets. One is you're creating market, do they create markets for you? And the other one is how do you create a moat for yourself within that market? And they have two very different purposes. Based on the stage that we're looking at, frankly, from a resources standpoint, and it's a little bit harder to do the former. We're usually reliant on other sources for that. But a great example of the second one of our breakout companies right now in our portfolio is a company called Tidal Vision. Tidal Vision turns crab and shrimp shell waste into chitosan. And chitosan, for anybody who knows that space, was outlawed. Domestic production was outlawed for decades because it was this hugely toxic process. And so these folks, Tidal Vision team, came up with a non-toxic way to turn crab and shrimp shell waste into chitosan. And it was outlawed by the EPA. The EPA wouldn't allow it. And so that was our strategy. And this was part of the capital strategy and everything else. 2 years of like, okay, let's go through the process. Let's surround ourselves with the best folks that can help us through this process. And ultimately, the EPA gave them basically an exclusive thing. You are the only approved for agricultural purposes, for example, chitosan process in the United States. And that created this instant moat around this company that has just absolutely set it off onto a rocket ship trajectory. So thinking about things through, thinking about whether your idea and your company can create either the market or the moat would be our two thoughts.
Yeah.
And I think the only thing that I would add to that is that there seems to be a broad swath of the venture community that's afraid of policy. And I would argue that maybe that means that there's an opportunity to actually embrace it. It's understanding where and how long and such, if there's a change that needs to be made, what that could be. But on the flip side of that is also having a strong business along the way, if one can. Maybe, again, there is some other form of capital, either venture or philanthropic capital that can support one during a change. I think it's just so hard. I think it's so hard to change policy. It just really is. So I encourage startups to really think about how to have a strong business without that change, or without relying on it.
You can open it up to questions. Yeah.
So my name is Alicia Putnam, and I'm a founding member of an organization called Electrify Oregon. What I've learned is that 40% of emissions come from just the day-to-day decisions we make about the cars we drive, how we heat our house, how we cool our house, how we heat our hot water. And yet, I feel like there's a funding conundrum. I feel like it's not a technology play, it's a behavior play. How does that get funded? I mean, to be honest, the idea of just like that nonprofit grind of begging for money feels like it's a huge deterrent for a lot of people, a lot of talented people. And when I hear you guys talking, it's like, yeah, that's a cool product that's being built and a cool technology, and look at that money that could be there, but how do you fund that basic shift that has to happen 1 billion times over?
I can take a quick crack at that, and then I'll turn it to you guys. I mean, what you're describing, we need to electrify everything and green the grid. So there's two components. If the grid was fully green, those decisions then wouldn't have a marginal emissions impact. But we obviously need to do both things simultaneously. And so, again, there is no silver bullet, but we think about those two things that need to happen in parallel. How do we motivate the deployment of more renewables on the grid? It's a series of policy, actually, around renewable portfolio standards. It's getting more storage deployed to pair with renewables. It's bringing down the cost of those things. It's kind of figuring out what the bottlenecks are to more deployment. So that needs to happen, and we need to find more ways to motivate that to happen faster. And then in parallel, how do we find ways to electrify everything in the home? Knowing that right now when we electrify, it doesn't mean that it's going to be 100% green, because our grid isn't 100% green, but we need to actually build the capital stock that we interact with as consumers, as residents, as people who dwell in buildings, and I'm sure Diane has some thoughts on this, to electrify that. And so we have a company that does heat pumps, and so we need to have a big conversion there. We need to change our cars to be electric. And so it's actually how do we create, in all cases, it's thinking about how do we motivate a switch at the consumer level to a device. There's a company that's doing that for induction stoves. How do you make a great one so that people will shift away from, a methane or natural gas burner to that? And so I think still as consumers, we still respond to incentives. And so it's just a different calculus. It may not be the same as the grid, where it fires based on the lowest marginal cost. It fires, but we make decisions based on something else. But it is appealing to, what drives consumers to shift in a direction of electrified and efficient. Load shifting, things like that. Yeah.
So my maybe hot take is that I think there's a lot of emphasis on consumers and not enough on corporates. Like when you actually look at emissions across the globe, overwhelming majority comes from corporations. And so I think that yes, consumer behavior is of course part of the calculus, but at the end of the day, like the way that we're gonna get rid of a lot of emissions globally is probably in the order of something like a carbon tax. Right, by actually penalizing organizations for not decarbonizing their operations. It's, most of these emissions are coming from huge oil and gas companies or highly pollutive, industries. And so, like, yes, consumer choice, it is a part of that. I also think it's like part of the narrative and part of the marketing to take onus a lot of times off of corporations. And so, I think my perspective is that we really need like much larger scale, like fundamental change to come from some of these enterprises, and it's in governments, and it's happening, but it's happening slowly. And so I think like the more that we can do to, it's really like shift policy and shift incentives at that level, I think that we will realize significant change in that way too.
I just throw in one slightly different, I'm glad you asked that question. I mean, I'm up here and I realize a lot today and a lot about what's happening with what Joanna said is about climate and decarbonization, and all those things are super important. But per my opening comments about it as a fund, we actually have about 15 questions that we ask ourselves from the very get-go, like, why do we wear what we wear? Why do we move the way that we move? Why do we eat what we eat? All these types of things. And then look at that and then start asking that question. Like, why do, whether it be corporations or individuals, why do they make the decisions that they make about what they choose to do? Our experience has been, and sort of back to your, Jenna's been just on all these points on, we have to talk more. 99% of the people that we talk to when we go out and do customer discovery with folks and just talk to them, if you're like, hey, if this was better, cheaper, faster, and good for the environment, it's like 100% yes. People are like, oh, absolutely. Now, what exactly is that? You're like, well, hold on, we're working on it, right? So to your point, it's so much about thinking about how do you understand what your customer's doing, what their needs are, and come up with something that meets those needs. And we're doing that all the time, like just like the shoes I'm wearing. I wear them on purpose. We're actually beta testing these shoes. Like the soles are made 100% out of algae. So these are algae-based shoes, a company called Genesis out of San Diego, and they're out like literally making pairs of this saying, wear these around, how fast do they wear out, how fast do they do it? Because ultimately, if they want to replace true polyurethane, for example, for all of our shoes, I mean, look at everybody's shoes. I'm guessing pretty much everybody in here probably has either leather or polyurethane in the shoes that you're wearing right now. If we want to change the polyurethane quotient of that, what does that have to look like? Why would someone buy a different pair of shoes? And starting from that premise is what we think is the way we need to be thinking about everything that we touch, eat, move, et cetera, make.
Oh, and now I'm going to put my thirdACT hat on, and one of the talks that we give is the fact that there's so much emphasis on the moonshot. We build this new technology, and this new technology, if it gets to scale, is going to make such a big difference, save the world and such. But sometimes I think the moonshot is actually the deployment of known technologies. So it's not actually in the technology itself, it is in the business models, it is in the financing. And so that's what we do as thirdACT. So as thirdACT, we're proud to be the first in the US to finance the transition of existing homes to net zero, particularly in low to moderate income communities. We're very much focused right now on resilience in extreme heat for those parties that aren't prepared for it. I could talk your ears off about the challenges and such. It's really interesting you mentioned corporates. Not to pick on Lowe's because I love them dearly, but if you go to the Lowe's and the Home Depots and such, just at Lowe's, we've counted there are 50 different types of natural gas stoves, only 2 induction cooktops, and that's in Sunnyvale, I think the closest one to here. We absolutely need to change and think about the consumer choices, kind of from that perspective as well. But yeah, it is important. It does play an enormous role. I think about 20% of U.S. emissions come from these decisions that consumers make in the home.
Thanks, everyone. Such a information-rich panel. My question is about the climate capital stack. In Saloni, you showed that nice graph, and venture is just one piece of it. And earlier, when we were looking at the speed and scale tracker, the latest one from Ryan and John Doerr, we saw that venture is probably the only one that has been achieved, and everything else is either on track, failing, or code red. And Diane, you mentioned donor-advised funds and kind of other instruments. So as you think about the capital stack and what we need in the future, what kind of instruments, is it catalytic capital, we talked about folk, do we need, and how do we accelerate other kinds of capital where there's a gap compared to venture, where it's great to work with emerging managers, but we need more in other categories.
Yeah, well, I have a pet answer to this one, but I'm going to let you guys go first.
The quick answer I would have is we are moving more and more our funds toward what we call the hybrid capital stack approach. Where our next fund is going to be in the blue economy space, so decarbonization, maritime fisheries, oceans, healthy oceans, sustainable fisheries, and decarbonization. And we actually have gone from setting that up as a single fund just going to be venture, and it actually has an entire capital stack. Now we have partners that we're working with so that we can actually start from the idea backwards and say, what's the fix that needs to be here? Oh, this one makes sense for venture, this one doesn't, but it's hugely important to unlocking this, and we have grant capital now. Some of you may know NOAA is coming out with a huge grant program that's going to be funding 5 of these innovation centers around the country, and using that grant capital to say, oh, you should be receiving the grant capital. You'll never be venture, but you're hugely important. And so being able to figure out sort of these, take a broader view, if you will, of the solution set, and then having the capital match, we think is going to be in the future, we'll see more and more of that.
That's great.
As we go forward.
And we talk a lot about grants, and particularly government source grants and such, and I mentioned donor-advised funds. About $1.4 trillion in the United States is held in donor-advised funds and foundations. Again, this money is typically invested before it's granted. That's about 4%, if I understand, of US GDP. And where that money is invested matters. Right now, much of this is going into ETFs and such, and not anything that is necessarily mission-oriented. So I think in the last quarter of last year, I spent those 3 months meeting with roughly 60 foundations, both private, corporate, and then community foundations, just helping them understand how to use recoverable grants. This is a type of grant that has some sort of a trigger of repayment. That way they can continue doing what they're doing with their investments, but turn around and take the grant side of the house and turn that into kind of an endowment model as well. And it's beginning to take off. There's a lot of appetite for it. There's a lot of field building that needs to be done through that. But nonetheless, that they see the opportunity to actually grow the amount of impact that they have. And it's, I think, going to impact this space tremendously.
Yeah, we need to recycle capital. And what we need, I think a lot about what we want is to find those fulcrum points in the system where you can actually get real leverage from capital. And so my current, one of the areas that I've been trying to kind of think about lately is around insurance and risk transfer products in climate. Because as you go up that, in my inverted chart, up and to the right, the risk appetite goes down. And the challenge is that part of I think we as humans de-risk things by knowing them. And part of the challenge of the pace that we need to execute this transaction is we don't have time to get comfortably familiar with everything before we go and deploy it. And by comfortably, I mean, the decades we've spent, we've spent getting familiar with what we have today. And so if you can have, sort of, and you see this, and there's kind of innovative companies that are working on this, but to your point, the innovation we need is in the capital markets too, is, can we take the perceived risk that exists around, if you have input, box, output, and say, what, we need a swap or a revenue floor or something on the offtake side, we need something, that looks like, something that gives you more security around input costs, and we need someone to come in and effectively give a warranty for the tech. And your traditional warranty firms won't do it because they look at it and say, that's a small market and a lot of work, and so I'm just going to keep doing what I'm doing. And so you need folks to actually, it's a return on time problem, which are the technologies you want to go deep on, which battery technology stacks, which electrolyzer sort of technologies do you want to go deep on and say, you know what, I've done the work on the technology, the tech will work. And so that's one area I think could use some innovation. I see our time is up, so I apologize to end abruptly, but really appreciate the questions and the time from everyone. And time of the panelists.